An initial public offering, or IPO, is a very important event for a company. It is the first time a private company offers its shares to the general public. Think of it like this. A company that was previously owned by a small group of founders or investors decides to sell small pieces of its ownership to anyone who wants to buy them. By doing this, the private company becomes a public company. Its shares can then be bought and sold on stock exchanges, like the National Stock Exchange or the Bombay Stock Exchange. This process is a major milestone, transforming the company's structure and future. Companies launch an IPO for several important reasons. The primary motive is usually to raise money. This fresh capital can be used for many things, such as expanding business operations, paying off existing debts, investing in new technology, or funding research and development. Another key reason is to provide an exit opportunity for early investors, like venture capitalists or the original promoters. These early backers can sell some or all of their shares and realize a profit on their initial investment. Going public also increases a company's visibility and prestige, which can help it attract top talent and build a stronger brand reputation in the market. In the case of HDB Financial Services, the upcoming IPO aims to achieve both of these goals. The total size of this IPO is expected to be around 12,500 crores rupees. This amount is divided into two parts. The first part is a fresh issue of shares worth 2,500 crores rupees. The money raised from this fresh issue will go directly to the company. HDB plans to use these funds to strengthen its capital base, which will allow it to give out more loans and grow its business further. A stronger capital base is crucial for any financial institution to support its growth ambitions and maintain stability. The second part of the IPO is an offer for sale, or OFS, amounting to a substantial 10,000 crores rupees. In an OFS, the money from the sale of shares does not go to the company itself. Instead, it goes to the existing shareholders who are selling their stakes. For this IPO, the main seller is HDB's parent company, HDFC Bank. HDFC Bank currently holds about 94% of HDB Financial Services. Through this OFS, HDFC Bank is reducing its ownership, allowing it to unlock the value of its investment and provide a wider public ownership for its subsidiary, paving the way for HDB's next phase of growth as a listed entity. HDB Financial Services is a well-known non-banking financial company, or NBFC, in India. It is a subsidiary of one of India's largest private sector banks, HDFC Bank. Being part of the HDFC Group gives it a strong brand reputation and a sense of trust among customers. The company operates through what is called an omni-channel or phygital model. This means it combines a physical branch network with digital services. HDB has a vast network of 1,771 branches spread across 31 states and union territories. This wide presence allows it to reach a diverse range of customers from different parts of the country. A significant aspect of HDB's strategy is its focus on areas beyond the major metropolitan cities. Approximately 80% of its branches are located outside India's top 20 cities. This shows a clear focus on serving customers in Tier 2 and Tier 3 cities, which are often underserved by larger financial institutions. The company's business is diversified across three main segments. The largest segment is enterprise lending, which makes up 39% of its revenue. This includes business loans, working capital loans, loans against property, and even gold loans. This segment caters to the financial needs of small and medium-sized businesses across the country. The second major segment is asset financing, which contributes 38% to the company's revenue. This division provides loans for the purchase of commercial vehicles, construction equipment like JCBs, and tractors for agricultural use. This is a critical area of lending that fuels economic activity in sectors like logistics, construction, and farming. The third segment is consumer finance, accounting for about 22.6% of revenue. This includes personal loans, digital loans for small-ticket items, and financing for consumer durables like refrigerators, televisions, and washing machines. HDB also earns fee-based income by selling insurance products for other companies. When we look at its financial health, HDB shows a picture of steady growth in many areas. Over the years, its assets, revenue, and net worth have consistently increased, which is a positive sign for any company. However, its profit after tax has been a bit shaky recently. After rising from 1,900 crore rupees, the profit dipped from 2,460 crore rupees to 2,175 crore rupees in the most recent period. The IPO is priced with a price-to-book ratio of 3.72, which is slightly above the industry average of 3.6. A higher price-to-book ratio suggests that investors are willing to pay more for each rupee of the company's book value, often due to expected growth. Every investment comes with certain risks, and it is crucial for potential investors to understand them before making a decision. One of the most significant risks for HDB Financial Services comes from a potential regulatory change. A draft circular from the Reserve Bank of India, dated October 4, 2024, has proposed new rules for banks and their subsidiaries. The proposal suggests that if a bank and its subsidiary have overlapping business activities, the bank must reduce its stake in the subsidiary to below 20%. Since both HDFC Bank and HDB offer products like car loans, this rule, if implemented, would force HDFC Bank to sell a large portion of its 94% stake. This potential forced selling by HDFC Bank could have a major negative impact on HDB's share price. A sudden large supply of shares flooding the market would likely push the price down. This regulatory uncertainty creates a cloud of doubt over the company's future ownership structure and stock performance. Another key risk is the recent deterioration in the company's asset quality. A company's health is often measured by its non-performing assets, or NPAs, which are loans that are not being repaid by borrowers. A rise in NPAs is a worrying sign for any lending institution. HDB's gross non-performing assets have increased from 1.9% to 2.26% in the financial year 2024. Similarly, its net non-performing assets have also risen from 0.63% to 0.99%. This indicates that more of the company's loans are turning bad, which can directly impact its profitability. Furthermore, a considerable portion of its loan book consists of unsecured loans. These are loans given without any collateral, like personal loans, and they carry a higher risk of default. Currently, unsecured loans make up 26.99% of HDB's portfolio, which, while down from 28.66%, is still a significant exposure. The NBFC sector in India is highly competitive. HDB Financial Services competes with several large and established players. Based on its assets under management, HDB is the fifth largest NBFC in the country, with a market share of around 2.2%. It trails industry giants like Bajaj Finance and Shriram Finance. When compared to its peers on key performance metrics, HDB does not always come out on top. It does not rank in the top 3 for profitability measures like return on assets or return on equity. This suggests that its competitors might be operating more efficiently or profitably. As we reach the final stage of our analysis, it is time to bring together all the key points that investors should consider before applying for the HDB Financial Services IPO. The decision to invest is a personal one and should be based on your own financial goals and risk appetite. One of the most attractive aspects of this IPO is its pricing. The price band is set between 700 and 740 rupees per share. This is a significant discount, almost 40 to 45% lower than the price at which HDB shares were trading in the unlisted market, which ranged from 1,200 to 1,350 rupees. This discount could offer a potential for listing gains. However, this attractive pricing must be weighed against the risks we have discussed. The regulatory overhang from the RBI's draft circular is a major concern. If HDFC Bank is forced to divest a large part of its stake, it could lead to a sharp fall in the share price post-listing. Investors must be comfortable with this uncertainty. Additionally, the rising trend in non-performing assets suggests that the quality of the company's loan book is under some pressure. While the company is growing, its profitability has shown some recent weakness, and it lags behind some of its peers on key efficiency metrics. The IPO also comes with special provisions for certain categories of investors, which is an important detail. There is a reserved quota for shareholders of HDFC Bank. If you held HDFC Bank shares on the record date of June 19, 2025, you are eligible to apply in this shareholder category. This gives you an additional chance of getting an allotment. Eligible shareholders can apply in both the retail category and the shareholder category, and both applications will be considered valid. This is a significant advantage for existing HDFC Bank investors who believe in the long-term story of the group. Finally, There is also a special quota for the employees of HDB Financial Services. Eligible employees can apply in up to 3 different categories if they qualify: the retail or HNI category, the shareholder category if they own HDFC Bank shares, and the employee category. In conclusion, the HDB Financial Services IPO presents a mixed bag. It offers the shares of a strong, well-regarded company at a discounted price, but it also comes with notable risks related to regulations and asset quality. Investors should carefully evaluate these pros and cons, consider the long-term growth potential against the short-term uncertainties, and then make a well-informed decision.